Module 6, Lesson 1, Stocks, Bonds and ETFs. Welcome to Module 6, Introduction to Investing. Today, we focus on a life-changing skill, how to make your money work for you. What you will learn in this module, you will learn what investing actually is, understand the trio of stocks, bonds, and ETFs, and grasp the magic power of compounding. We will also navigate risk and emotional control, cover crypto basics, and show you how to build a beginner-friendly portfolio. Why investing matters? Investing matters because it beats inflation, ensuring your money grows faster than the rising price of goods. It builds long-term wealth and passive income, allowing your money to work while you sleep. Ultimately, investing leads to financial freedom, giving you more choices in your life and career. We begin with Lesson 1, Stocks, Bonds, and ETFs. What is investing? Investing is using your money today to grow your wealth tomorrow. This process is centered around three core elements: time, capital, and growth. Saving versus investing, it is crucial to understand the difference. Saving is about protecting your money. It features low risk and a safe principle, but minimal growth. In contrast, investing is about multiplying your money. It involves higher risk, but also the potential for significant growth. Why people invest? People invest to build wealth beyond traditional savings and to plan for retirement. It offers protection against the rising cost of living and provides regular earnings without active work. It is your primary path toward financial independence. What are stocks? A stock is simply a small piece of a company. When you buy a stock, you gain ownership in a portion of that company. Stocks offer the highest growth potential as they allow you to share directly in a company's profits. How stocks make you money? Stocks generate wealth in two ways. First, through price increases. You buy low and sell high, resulting in capital gains. Second, through dividends. These are regular payments from company profits, typically paid quarterly, which can be reinvested to accelerate your growth. Examples of stocks. Well-known examples include Apple, Tesla, Amazon, and Coca-Cola. These represent different sectors, from innovative technology and sustainable energy to global e-commerce and established consumer brands. Why stocks grow? Values rise when companies expand their market reach, report higher sales, and utilize strong leadership teams. Innovation, like new products or technological advances, gives companies the competitive edge needed to drive stock prices up. Stocks, risk and reward. Stocks offer high return over time, but they carry medium risk due to market volatility. They are best for long-term investors who can commit 5 or more years to ride out market cycles. What are bonds? If a stock is ownership, a bond is lending. When you purchase a bond, you lend money to an entity, such as a government or a corporation. In return, they pay you interest plus your principal back at maturity. Why bonds matter? Bonds are valued for their lower risk and capital preservation. They provide predictable fixed income returns, which helps balance portfolio volatility and provides a stable income stream. Types of bonds. Government bonds are low risk with fixed payments. Corporate bonds are issued by companies. They offer higher yields but carry variable risk. Treasury bills are very safe, short-term government securities, typically maturing in under 1 year. Bonds, risk and reward. Bonds typically offer a low return with modest growth. However, they represent low risk and are seen as a stable and safe way to protect your principal. What are ETFs? ETFs, or exchange-traded funds are baskets of many stocks. They hold multiple assets in one investment, offering instant diversification. They trade just like individual stocks on an exchange. Why ETFs are perfect for beginners? ETFs are ideal because they reduce exposure to any single company's failure. They are easy to buy on any brokerage platform and typically have much lower fees than actively managed mutual funds. Examples of ETFs. Common examples include the S&P 500 ETF, which tracks the 500 largest US companies, the NASDAQ ETF, which focuses on high-growth tech, and global ETFs, which diversify your money across the entire world. ETF equals instant diversification. Remember, one ETF can equal 100 plus companies. This provides widespread market coverage and helps maintain portfolio balance through automatic rebalancing. Stocks versus bonds versus ETFs. To summarize, stocks are high risk, high return, and best for growth. Bonds are low risk, low return, and best for stability. ETFs are medium risk, high return, and best for beginners. Long-term investing wins while markets go up and down. Historical data shows that over decades, markets are always rising. The key is emotional control. Patience always beats panic selling. Beginner mistakes. Avoid 3 things: buying hype without research, trading emotionally based on fear or greed, and not diversifying. Putting all your money into a single stock bet increases your risk of total loss. How much to start? You can start with any amount, even $5 or $10. Consistency is more important than the amount. Modern platforms allow for micro-investing through fractional shares. Investor mindset. Be patient, focusing on the distant goal. Be calm, making rational decisions during market swings, and stay long-term focused, knowing that true wealth happens over decades, not days. Compound growth. Preview in Lesson 2. We look at compounding. This is where returns earn more returns, creating an exponential snowball effect. For example, $1,000 growing at 10% becomes over $6,700 after 20 years. That is the power of time. Key terms. Remember these. Shares are units of ownership. Dividends are profit distributions. Market cap is the total value of a company, and the ticker symbol is the unique code used to trade it. Tools for investing. You will need trading apps for a user-friendly interface, brokerage accounts for professional research, and ETF platforms specialized for low-cost tracking. Safety first. Use trusted platforms only. Ensure they are regulated by financial authorities, insured against fraud, and have a strong established reputation. Lesson summary. In summary, you now know the building blocks. Stocks equal ownership, bonds equal lending, ETFs equal diversification. Next lesson. This concludes Lesson 1. Our next lesson dives deeper into compounding and risk management. We will cover how to balance risk for optimal returns. Continue to Lesson 2.